The real estate sector has been taking a hit for quite a while now, and this might present a great opportunity for long-term passive income investors and even growth investors as well, just by looking at how big of a hit some of these companies have taken. Now, of course, some of these are paying a high yield, so some of you might say, oh, high yield means probably not so much growth. Well, I think the high yield right now has more to do with the fact that the stock has come down quite a lot rather than the business not growing as fast as you would think. Now, with regards to REITs specifically, they need to redistribute 90% of their taxable income in the form of a dividend. And as we get near to the end of the rate hikes and closer to rate cuts, I do think that picking up quality REITs right now might be very, very lucrative. So let's talk about 4 of these REITs. I'll go from the lowest yield to the highest yield. That doesn't mean that one is automatically better than the other. Just thought this would be a better format for this video. So company number 1 is American Tower, 3.6% yield and paying $6.28 a year. Now, this is a cell tower REIT, and of course, right now we are more connected to tech than ever before, and there is no end in sight, in my opinion. Of course, you might say, yeah, but with the rise of satellites, connectivity, etc., that might pose a threat to American Tower. While I do agree that the rise of satellite is something to keep an eye on, I don't think it will impact that business anytime soon. Now, American Tower operates at a global scale, as you can see here, with nearly 226,000 sites. If we look at their dividend profile, so shareholder yield as of the last quarter, 6.38%. And as you can see, this is a company that has been increasing its dividend for quite some time. Now, looking at their recent quarterly earnings, you can see that property revenue increased 4.4% year over year, or 6.3% on an FX neutral basis, and tenant billings growth at 7.2%, with the largest growth being in Africa. If you look at their outlook for 2023, you can see that they are raising their outlook by around $125 million versus their prior outlook. And looking at the attributable AFFO outlook, they're also raising that by 5 cents at the midpoint. And last thing here, with its current price sitting at $173, if you look at the average price target, most analysts are looking at a 30% return potential from the price it is today. So you're not only getting stock growth here, but you're also getting dividend growth, which is great. Now moving up to REIT number 2, and this is one that I recently added to my own dividend portfolio. If you've been following this channel, you know exactly which company that is, and that's Vici. So Vici is paying 5.2% yield, $1.56 on a yearly basis. Now Vici itself is a real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations, including Caesar Palace in Las Vegas, MGM Grand, and the Venetian Resort. Now, they're not only in Las Vegas, they have 50 properties spanning 15 states and 1 Canadian province. Now, with regards to its dividend durability and growth, I mean, it's pretty impressive. So Vici has raised its 100% cash dividend every year while targeting a 75 AFFO payout ratio. And now looking at their recent earnings, total revenue increased 35.5% year over year to just under $900 million. AFFO attributable to common stakeholders increased 25.7% to $540.4 million. And here as well, if you look at the current price, which is just under $30, and you look at the analyst estimates, the average price target sits at 24.58% higher than the price it is today. So I hope you're starting to see the message here when I said at the start that REITs are becoming extremely attractable, not because of the dividend that they're paying, but also because of the stock growth potential that you're getting right now, because this sector has been beaten down for quite a while. Now, before I go and jump into REIT number 3, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. And of course, write your holdings down in the comments below. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And now company number 3 is a very, very famous dividend paying company. It's one that pays a dividend actually each and every month, and that's Realty Income. So Realty Income has a dividend yield of 5.4% currently, meaning $3 a year. Now, here you can see the bigger picture. So strong returns, 14.2% compound annual total return since 1994 New York Stock Exchange listing, 4.4% compound annual dividend growth rate since that listing, 637 consecutive monthly dividend declared, and 103 consecutive quarters of increases. So safe to say that this dividend is pretty safe. Now, if you look at their portfolio, you can see that the majority of it is in retail, then you have industrial, gaming, and others. And looking at it by industries, convenience stores number one, then groceries, dollar stores, home improvement, drugstores, CVS, stuff like that. Actually, you can see this here on the left. So decline the top 20, Dollar General, Walgreens, 7-Eleven, CVS Pharmacy, as you can see, Walmart, Tesco, etc., etc. So just by looking at this reinforces what they've shown us before, right? The dividend is safe because their business is extremely robust. Their clients aren't small startups that might not pay rent next month. Their clients are companies that have been here for quite a while, not just a couple of years, but decades. And looking at their earnings growth, again, reinforces that statement that the dividend is safe and the dividend will continue to grow. So if you look at the AFFO per share growth, so a 5% historical median, which is stronger historical rate versus other REITs, positive earnings growth in 26 of 27 years, modest annual downside volatility of just 2.7%. They continue by showing us here that they have a proven track record of maintaining 5% or more earnings CAGR since listing, regardless of the size. Earnings growth has accelerated as the portfolio real estate value crossed $10 billion. As you can see, 6.6% AFFO per share CAGR since 2012. And here as well, looking at the stock price today, $56. If we look at the analyst price targets, the average there, they see 21.74% return potential. And now REIT number 4 is one that is paying over $7 per year, 6.4% yield, and that's SPG, Simon Property Group. Now, Simon Property Group is an American real estate investment trust that invests in shopping malls, outlet centers, and community lifestyle centers as well. It is the largest owner of shopping malls in the United States. And as you can see here, the net operating income composition, 71.6% US malls and premium outlet, followed by the mills, international, and TRG. Now, with regards to SPG and its dividend, I know this will be mentioned in the comments, so let me cut to the chase here. They cut the dividend in 2020 to protect itself and investors because of, what was going to happen and what was happening. But since then, the dividend has grown back and will be back to 2019 levels sooner rather than later. They also recently had their quarterly earnings, their raised fiscal year guidance, and their dividend. And here as well, if you look at the current price, $113. And if you look at the average analyst price target, you have a difference of 16.75%. And I know some of you might be saying, malls, is that risky? Who goes to a mall these days, etc., etc. Well, now maybe during the summer months, it's a good example. Go to a mall and tell me if it's not full. Especially during the warmer month, I think malls are always full, and women specifically love to go to malls as well to shop. If you have a family, going to the mall is like a small little trip, right? There are some games for kids. You can eat, you can shop. It's a whole experience. So no, I don't think that malls will go anywhere anytime soon. And by the way, e-commerce is still just a tiny portion of the overall retail market. So to conclude, these are the 4 REITs that I think are extremely attractive right now. Of course, do share your list down in the comments below. And if you own one of the 4, let me know down in the comments below what you plan on doing, buying more, holding. Leave it all down in the comments. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.